401k participants, welcome to Kathmere Capital Management's end of the year 2021 market and investing update. My name is Kevin McDermott. I'm the one here at Kathmere Capital who's going to be presenting some of this material to you today. And this is meant to serve as a good educational 10 minutes on what you should be thinking about as a 401k plan participant regarding investing. A little bit of a recap of what's going on currently in the investment landscape, and we'll just dive right into it. The first thing is, why save now, right? Why use your plan? How much is enough and how much is right for me to save? And then what type of investor are you? These are the four questions you want to consider at all times when you think about making changes or getting involved in your company's 401k plan. I think the most important thing to think about here, and this is a refresher for many of you who have seen this before, is what can we control and what can't we control as it relates to all of us as investors and all of us as savers. We know that we can't really control market returns, and we know that we can't control policy in Washington regarding taxations or savings and benefits, government programs and the like, Social Security. Those are things we just can't control. We have some control over, how much we take care of ourselves, our longevity. We have some control over, how much money we make and how much focus we put towards doing everything we can there to generate funds to save. And then things that we totally control are, how much are we saving and how much are we spending? What can we in our own personal lives do to create the ability to save? Where are we spending our money? Where can we save? And then how do we invest? What's our asset allocation decisions? Are we doing the right things as investors to make this journey a success? We'll get into that a little bit. I think the first thing to understand is that the Department of Labor typically recommends that most people save anywhere from 10 to 15% of their income each year into a retirement plan, if possible. That could include your company's match. We know during some phases of life, this is very, very difficult to do, based on kids, based on expenses. Sometimes later in life, people are able to catch up a little bit, but you'll see in a little bit in this presentation that starting early is critical. It has tremendous benefits. It's never too late, but certainly starting early has its benefits. So that's a number to have in your mind when you think about how much am I saving and what can I afford? And am I anywhere near that target recommended allocation? Looking and saying, hey, how can I create savings? And, for some people, it starts with looking at what you do on a daily basis, looking at what you do on a weekly basis. And are there ways that we could drink a less expensive coffee? Is there ways that we can cut things out of what we do every day just to try and create some, potential savings into a 401k plan? And you can see that there are people out there that said, you know what, I'm going to drink a less expensive coffee or make one on my own. And, it creates a dramatic impact at retirement. And I think the point of this page is simply just to say, what can I do in my personal life, looking at my expenses to try and create the opportunity to save or to save more? And it's a good exercise for us all to go through. This is a story of 4 savers en route to retirement. I will get to Consistent Chloe in a minute, but let's start with Nervous Noah. So Nervous Noah is someone who saves all the way from 25 to 65. But they pretty much just invested in the money market option in the plan. That's the most conservative option in your 401k plan. So this person invests $96,000, but at the end of 65 years, they only have $147,000, even though they invested the most amount of anyone on this screen, moving up towards Consistent Chloe. Quitter Quincy is another investor. She starts at age 25 and stops at age 35. And she earns 6%. She only saves $24,000. But when you believe that because the rate of return was 6% and not 2%, that $24,000 actually grew all the way to $192,000 when she retired. That's with saving no more after age 35 all the way to age 65. Just those savings from that initial 10 years were able to grow for her from age 35 to 65. Late Lila is someone who, didn't start saving like Quitter Quincy did at age 25. She waited till age 35, but she saved every year from 35 to 65, a total of 72,000 total. She grew, ironically, even though she saved 72,000 and Quitter Quincy only saved 24,000, she ended up with 201,000, which was only about $8,000 or $9,000 more than Quitter Quincy. So the benefits of starting early, you can see what Quitter Quincy did there is dramatic, that Lila saved so much more, but ended up with not that much more in retirement because Quitter Quincy started earlier. And then there's Consistent Chloe, which saved every year, just like Nervous Noah, but Nervous Noah got 2%, Consistent Chloe got 6%. And you can see that she turned that $96,000 into almost $400,000, $393,000. So there is a story here to say, if you start as early as you can and you invest appropriately, you can do some wonderful things in your 401k plan. In terms of investment options, there's really two ways to do it. One is, hey, help me do it. You know, I'm not someone that watches CNBC. I'm not someone that reads the worst Wall Street Journal. I really want some help with this stuff. I just want to make sure I'm investing correctly for someone that is my age, sort of on the journey to retirement. And then there's, of course, do it yourself, which is, hey, I like this stuff. I want to be actively involved in picking my investments, rebalancing them. And we're here to support those people if they were to have any questions about those individual options, for sure. But those folks that say, hey, help me do it, there's really one answer for that person. And this, quite frankly, is how I invest my retirement savings in a large majority. And those are these retirement date funds. So these retirement date funds, you'll see a year at the end of the name of each fund. That's a prospective retirement date. So I'm 44 years old. Let's take the 2045 fund. The 2045 fund is going to be invested like somebody that's going to retire in about the next 20 to 25 years, right? So it would be far more aggressive than the 2020 or 2025 fund, where that person is saying, hey, I've accumulated, I'm going to retire pretty soon, I want to be more conservative. And it would be less aggressive than someone who's, let's say, 21 or 22 invested in the 2065 fund. The key for these funds is that they're not only invested appropriately today in 2022, based on when you might retire, but if I kept my money in the 2045 fund all the way from now until my retirement, that fund would get ever so slightly more conservative every year as I reached those years in the 2040, 2043, 2045 timeframe. So it truly is an autopilot approach. These are managed, depending on your plan, by the Vanguards, the American funds, the Fidelities of the world. And these are some really smart individuals behind the scenes that, instead of you picking the 10 or 20% in certain funds individually, they're going to do it for you. And they're just going to make sure you're appropriately invested based on where you are on your retirement journey. This is some basic market facts to consider, is that over the last almost 100 years, the stock market has produced considerably outsized returns versus bonds and cash. It's really, really important for young people to understand the word risk. And risk really comes in two forms. One is market risk, which means I need the money in the very near future, and I don't want it susceptible to a short-term market decline. But the real risk to be considering for all of us as investors is really purchasing power risk, and that's in inflation. So we all know that many seniors today paid more for their last car than they did for their first home. And it's very important to understand that if you are 25 or 35 or 45 and you want to retire at 60, 65, 70, especially with people living longer these days, we really need our money to grow. So although you might be saving for a new car or some home repairs or a second home or whatever your particular goals might be, for an account that you're probably not going to touch for 10, 15, 20 plus years, you really need to make sure that you're turning off the noise that is the day-to-day news on the stock market and investing this for long-term growth. It's really the way to get ahead. This just shows where, if you were a moderate investor in global equities, you didn't pick one area of the market, but you invested in a global 60-40, 60 stock, 40 bond portfolio, how that returned all the way through the end of 2019. 2020 and 2021 numbers will be added to this soon, but you'll see that global investments diversified always seemingly are in the middle of the pack, and they did very, very well. So diversification works. Trying to figure out where the perfect time to invest is perfect place to invest is very, very difficult. But having that balanced approach for many of you that are more than halfway towards retirement is really the right way to go. And this is what those target date funds do for you. Really important slide to understand about markets. is they often go up. You'll see that most years here, markets actually went up since the early 80s. So you'll see that about six times markets went down over about the last 40 years. But every year, even when markets go up, markets just don't go straight up. So you'll see the light blue at the bottom says that, well, even though in like 1997 and 1998, 1999, markets went up 33, 29, and 21%, during the year from a high to low, maybe it was from May to August, maybe it was from March till May, the market decided to go down, 11, 19, and 12%. So if you slept from January 1st until December 31st, you woke up and you saw a great return. But don't ever forget as investors that during the year, it's very, very normal for you to see volatility. We're seeing volatility right now in the market, and investors are going to power through that, and people that are emotional, might get caught up in it. But markets do not go straight up. They go up over time. But make sure you understand, historically, there's always tremendous volatility, even in the years when markets do very well. So basic market update, I'll call your attention to, last year. Last year, US stocks did incredibly well, up almost 30%, about 28.7%. International stocks did well, but lagged considerably. And emerging market stocks did very, very poorly. That was led by a real poor performance from China, which is about a 30% holding in emerging market stocks. For you longer term investors out there, you can see that over 5 years and 10 years, you're going to see a lot of green here. You're going to see an incredible run in equity markets over the last 5 to 10 years. That's through Republican and Democrat administrations. That's through many different calamities in the world, including a pandemic no one could have dreamed of. I think it's also to consider here that when you look at T-bills, which is your typical bonds and US bonds, short-term bonds, you'll see that short-term, you really have no idea what's going to perform better. US bonds versus equities. There are times when bonds outperform equities. But over long periods of time, for my young participants out there that are thinking, what's the right way for me to invest over the next 10, 20, 30 years, you can see the dramatic outperformance in equities versus more conservative investments over that time. So it's really, really important to understand this. And for those out there that need to be investors, understand that investing is a long-term scenario, and over long periods of time, these returns are typically what you see as it relates to equities versus bonds. Looking at last year, to sum up, we had a year where the market did incredibly well. It was up 28.7%, but only about 57 of the days were actually up. So if you're the kind of person that looks at your phone at 4 o'clock every day and see how the market did, it's still almost a coin flip between up and down days. The best day and the worst day were comparable. The best day, the market went up almost 2.5%. The worst day, the market went down a little larger than 2.5%. Very surprisingly, the biggest drawdown last year was about 5%, 5.12%. Typically, the market is far more volatile than that. And the market made all-time highs. And the market's been making all-time highs since 1926. So all-time highs is not something to be scared of. I think investors throughout their lives are going to continue to see all-time highs. Nobody knows what 2022 or even 2023 is going to bring. But if you believe in capitalism and believe in an economy that produces goods and services that we're going to use and continually innovates, I think you're going to continue to see a reward for taking an interest as a shareholder in successful businesses. And you can do that through the target dates and through the mutual funds in the 401k plan. The US economy has grown. Just last year, our economy was valued at about $33 trillion. A year later, it's $42 trillion. That can mostly be backed by earnings. That is not a pie in the sky. These large companies all the way down the list are making more money than they ever have, and valuations has reacted accordingly. So I want to thank everybody for taking part today. Hopefully this helped you as you think about you as a participant, you as an investor, you as someone who's trying to prepare for retirement. If you have any questions, I would encourage you to reach out to Grant Boyle. He runs participant services here at Kathmere. His contact information is attached. We are here to support all of you as participants over time. And if you have any questions about the plan, any questions about your particular investment, we encourage you to please reach out. Thanks and have a great day.